Hey everyone. This is an interesting conversation. Not the conversation I expected after election day, but I guess that's yeah, the nature of couches. Yeah. Um, just as a reminder, I want to kind of give you an update so where we're scheduled and what we're looking at right now. We have three more lectures effectively that are going to be taking place. Already, they always just get riled up right at the beginning of class, right at the beginning. Oh. You have to go talk. Say, settle down, settle down. The only one class is allowed to get excited is this one right here. Okay. All right. So we have oh my God, got my train of thoughts just off. Three more lectures. One of those is supposed to take place Monday, but I will actually be in another classroom on Monday because I'm going to be working on a research project. So I mentioned that. I will record the lecture and have you all watch it. I'm going to do that tomorrow, so it should be available sometime, I would guess, early tomorrow afternoon. So please make sure you watch the lecture. You can come in here if you're just really gonna have a problem watching the lecture and align it with course, you can come sit in this classroom, pull out your computer and watch it here. That's the easy way to go around it, but it's just at your schedule. But you'll want to watch that as the content will be on the exam. It's going to be chapters 14 and 15. We have homework for chapters 12 and 13 on Friday. We've got chapter 16 next Wednesday. It's our last lecture. Then we're going to have homework on chapters 14, 15, and 16. Basically, a little bit less than 2 weeks from now, which I guess would be November 18th, we're going to have our exam review. Our exam review. Dr. Hayden will be joining us for the exam review because she wants to learn more about auditing. That's the excuse I'm telling you to care for it. I actually don't remember if on the practice exam if I use Casey Staden as the name or not, but that'd be funny, wouldn't it be? Anyway, Wednesday of week 14, which is right before break, we have our exam, and so then we have are not going to meet the Friday before Thanksgiving because I generally give that off. That being said, you'll have to basically wait a week and a half before you can find out what your score on the exam will be, which I know the suspense will kill you, but hopefully you can get over that with some tryptophan-induced food. So yeah, tryptophan-induced coma. Then we'll have our presentations the following week after the exam review. Today we're going into another one of our process areas. This one is an important one. I do have some feelings about this one. I think inventory is mismanaged by a lot of audit organizations. I'll talk a little bit about why that's the case here in just a second. We have talked about this to some degree, and it's pretty straightforward as to why. It's because the inventory process is basically a subset of our two primary process areas. So we can consider in the context of the ones we've already discussed, purchasing involves companies purchase inventory or raw materials for inventory production. And then revenue, they sell inventory to generate sales revenue. So we've already discussed this to some degree, but we need to get into a little bit more of the specifics about what is involved within the inventory management process. All right, so we're going to jump right in and we're going to cover some of the things that I generally wait until like the middle of the lecture. We're going to get right into it right away. So documents and records included in the inventory management process. These should look fairly familiar. At least the receiving report will look very familiar because that was one that we had as part of the revenue process. The other ones and shipping order, that's actually going to be part of the revenue, or sorry, receiving report would be the purchasing process, or shipping orders revenue process. My apologies. Then the other documents, those are a little bit less significant, but still things that you've probably seen before, especially if you, from your cost accounting classes with Dr. Otero. The internal documents that manage inventory maintenance, manufacturing, and management of the inventory items themselves. As far as the inventory process goes, this is completely and wholly unsatisfying, but what are the functional areas of the inventory process? So this one's a little bit challenging simply because of the nature of the inventory process. But there's a lot of overlap in these process areas with the other areas. So I tried to pare this down as much as possible. It's still going to be a little bit of a challenge. So there's inventory management, which is basically going to authorize inventory purchases and production. And that's just a general term for anything that is going to coordinate inventory for the use of other parts of the organization. And then we've got raw materials, manufacturing, and finished goods. And so these kind of correlates to what you learned about in manufacturing. Raw materials is obviously raw materials. Manufacturing is going to be our work in process, and then finished goods is the completion of the production. For the most part, this is going to be isolated to manufacturing process. If we're talking about a merchandising firm, then we're going to be focused just on finished goods because we buy and then resell the same goods. And so we wouldn't have these steps in a merchandising process, but just for context, I wanted to leave those both in there. Cost accounting is going to be maintaining the production and purchase data. And so this is a little bit separated from the financial reporting aspect because remember, this is more operational in nature. And then we have our financial accounting, which is going to be the recording that information on the general ledger and the accounting for three-way match. So there's a few things that I want to note here before we move on to kind of our standard approach. When we talk about inventory, the book actually notes that segregation of duties is particularly important for inventory. Why is that the case? Well, keep in mind our segregation of duties are custody of assets, authorization of transactions, and recording of transactions. And these are usually trying to prevent any kind of misstatements or any illicit activity related to the inventory function. Just a quick question, and this is not meant to be a trick question, but I want to make sure that we're clear. When we talk about fraudulent activity, obviously cash is going to be a big concern, and we'll discuss that next week when we get into cash. But is theft of inventory a concern for many organizations? Yeah, obviously so. All right. And because of the nature of inventory, it is going to be probably the second most common asset that we see is going to be stolen by stakeholders in the organization. The first obviously being cash. Cash is the most liquid asset, but inventory is really concerning. And so the part of the reason that we need to be very careful about controls in this area is that if we don't have proper controls, then it's very, very easy for this misstatement to occur, largely because of theft in those areas. So making sure that we have good controls over custody, authorization, and recording of transactions are going to minimize the amount of inventory theft that can take place, and to a lesser degree, minimize the amount of misstatements that can occur related to inventory. So let's go through these just real quick. And again, this is going to be less useful than it is for revenue and purchasing. It's unlikely that I'm going to get too much in detail about the segregation of duties function down here at the functional level, but I do think it's important at an aggregate level to think about. So inventory management, this is going to be our authorization function. This is where we authorize the inventory management or production and purchases. So if we need inventory, that's where somebody says, all right, I'm going to authorize the purchase from the vendor, or I'm going to authorize additional production as needed for this particular organization. Raw materials, manufacturing, and finished goods. These are all stages of inventory. And as we know, inventory is an asset, okay? So we can think of these as various phases of custody, all right? The custody chain is going to be maintained depending on what type of inventory we're actually manufacturing or maintaining. Cost accounting, this is pretty straightforward. This is internal recording or internal recording of information. So this is going to be a recording function, as is general ledger and accounting. That's basically organizational. Now, as I said before, when I specified this, cost accounting is more operational in nature, whereas the general ledger is more financial in nature. So the financial recording is going to be for external reporting, whereas usually this is for internal purposes. Also, it's important to note that there is a three-way match that can occur here. These three-way matches are the same three-way matches that we talked about in the revenue and purchasing processes with documentation that can actually be matched across those processes as well. All right, let's get into our risk assessment discussions. So, inherent risk. What should others consider as part of the inherent risk assessment of inventory? So, obviously speaking, we've talked about different process areas, and we've said, yes, there are inherent risks in organization. That is going to be true for inventory. Some of these are very, very obvious and apparent. One of the big ones we talked about is we talked about industry conditions with competition, new entrants. We talked about changes in technology being paired along with that. So industry conditions can change and can change the environment that organization operates in. If we're talking about a technology industry, is really important to note is that changes in technology can make certain products obsolete. And of course, my favorite example is this thing right here, okay? I still miss it every single day, all right? But that's a good example of the kind of risks that an organization faces on a daily basis. So we talk about any internal environment or any external concerns in the environment can actually change the operations that an organization has to meet. This is one of those reasons that when you see manufacturing or merchandising firms usually change up their product assortment from period to period, it's trying to address these risks and these changes in consumer preferences or changes in the environment to be able to address those. Some of these have been very, very widely reported on. Has anybody heard the recent news reports about shrinkflation? And you heard the terms that. So Inflation is basically what it's addressing, and one of the ways that companies address inflation is to make their packages smaller. I think Frito-Lay recently got dinged on this pretty hard, is that people were saying there's less volume in their packages of chips. So the packages themselves were the same size, but the amount of product inside the packages was less, and that was one of the ways they were addressing them. Now, that's interesting because that was actually a response to a risk. When we're talking about inflation, that's a risk to any manufacturing or merchandising organization. And so they were addressing that by saying, we're going to manufacture, we're just going to put less product in there and charge the same price, which is devious. It feels like that's dishonest somehow, but I will say that's one approach they have to take in the face of rising prices. Obviously, I've talked about it before. I feel like I'm using the word obviously a lot today. I apologize for that. Sometimes I get on a kick and I use same words over and over again. We have fraud risks, okay? What is our biggest fraud risk with respect to inventory? That's going to be misappropriation of inventory. So people stealing inventory, something we're very concerned about because inventory is probably the second most portable asset that we could have. Now, any asset can be subject to misappropriation of asset, but one of the concerns we have in inventory is that it is highly portable and highly liquid, and it can be it could actually be resold, or in many situations it can be consumed. So if you go to the grocery store and say, I didn't feel like paying for these bananas, I'm going to put them in my pocket. You'd have to have big pockets first of all, okay? But you can technically steal that and consume them yourself and save yourself the money on that. Another thought, do we have fraudulent financial reporting concerns with respect to inventory? Oh yeah, you betcha. Fraudulent financial reporting frequently occurs surrounding inventory. This is one of those schemes that we talked about in the revenue process. What happens when we overstate ending inventory? What do you think happens? Well, let's consider that. Okay, let's think about what's happening with overstatement of inventory. So let's say a company has done their periodic inventory count. They have $1 million in inventory, in ending inventory, but they overstate that and say they have $2 million in ending inventory. Okay, so what is that going to do to cost of goods sold for the year? It's going to make a cost of goods sold lower. Cost of goods sold is going to make, or if we decrease cost of goods sold, what are we doing to income in that period? Increasing our income. So it doesn't seem counterintuitive. It seems like if we overstate inventory, that it should increase cost of goods sold reported. But in the way the math works is that you increase the ending inventory count, you decrease cost of goods sold for the period, and you increase operating income for the period, which is one way that a lot of organizations have found to commit fraud, by misstating inventory. So we have to be very, very concerned about that. Another subset that the book talks about, this is a little bit less prominent, but still important to note, is going to be related party transactions, both buying and selling inventory. Keep in mind that we have not abandoned our responsibility as auditors just because we're now in the process areas. We do need to identify transactions that may be related to related party transactions, and determine if those transactions occur, what would be the equivalent of an arm's length transaction. So if we see the organization is selling inventory or buying inventory to a party for preferential terms, we would want to identify that and make sure that's properly disclosed in the financial statements. All right, control risk assessment. Guys, I'm sorry, we're not there yet. We're not to substantive procedures yet, or substantive strategy yet. We're still on reliance strategy, which makes sense because most of the organizations we're talking about are going to have many, many inventory transactions, the buying and selling of inventory. So transactions surrounding inventory are not going to be small enough that we could actually test the transactions themselves. So in most of our scenarios, I mean, I suppose you could say if we were auditing a firm like KPMG, what inventory do they have? Like golf caps? Okay, so maybe inventory. That's probably not a material account category for KPMG anyway. Have you guys noticed that I'm still bitter about the whole golf hat thing? I mean, it's we're now like 15 years past that whole ordeal, and I'm still mad about it. So yeah, I don't ever let things go. Anyway, KPMG and their golf hats, yeah, that'd be the inventory. We probably wouldn't even testing that simply because it's such a minimal amount. But if they did, maybe that's a scenario we use a substantive strategy. Our organizations, for example, these are going to be using reliance strategy because there's going to be multiple inventory transactions. So we want to rely on the controls to give us our assurance. So we need to plan and perform our test of controls on inventory transactions, set and document the control risk for the inventory management process. All right. So how many tables did I say I was going to give you guys? 6. Okay, we've done 5 so far. This is number 6. Okay, we don't have control testing tables for the finance and investing processes. Even though I thought that was too much, but this is number 6. Again, as before, look at the table. All right, review the relevant assertions associated with the risks and the misstatements, identify the control activities, testing controls. As was the case of the PREO role, your focus at this point should be understanding the relationships of the table rather than trying to memorize them. I'm going to say this one last time today. I probably will say it again during the exam review. Do not memorize the tables, but make sure you review them in detail so you understand what the relationships look like, okay? Our example for today, we have completeness, okay? So what would be a concern about completeness? Well, what do we call completeness? What is completeness? What is it? What is the concern we have surrounding the completeness assertion? We want to make sure things are what? All transactions are recorded, okay? So if we're talking about inventory, we could be having inventory that got received, so it's sitting in the warehouse, but it's not in the books. Is that a possibility? Certainly, okay, certainly. We actually talked about that. We talked about that back in chapter 5 when we were doing our testing. Remember, we did sheet to floor and floor to sheet testing. We were testing both existence, occurrence, and completeness. And we identified inventory that was in the warehouse, but was not in the system. That was a completeness violation, a completeness issue. So what are some ways that we can actually, our organization, the clients that we're auditing, can actually make sure that transactions get recorded? Well, we do a match to, or they do a match to make sure receiving reports are matched to the vendor invoices and the purchases journal. So the receiving reports, once it's in, they actually send copies of that to subsequent process areas or subsequent functional areas. And so the vendor invoices matched against the receiving report and purchase journal get matched against the receiving report. So if there's an outstanding receiving report, say, hey, where's this? Should there be an invoice of this? Should this go in the system? And the answer is yes for both of these. All right. If that control works, that would say it's an effective control. Is the direction correct on this, by the way? Are we moving the correct direction? So receiving reports, purchasing, or in vendor invoices, purchase journal, we're moving up. That's moving up. That's the letter T. It's tracing. So we're moving bottom to top. Is that completeness? I hope so. I've been using this slide for a long time now, so I'm going to be really embarrassed if it's not. It actually is. It is. I'm comfortable with that. All right. So if that's the case, what would be a good control activity? Do you think that, or sorry, good test of controls, excuse me, good test of controls. Do you think a good test of controls might involve tracing? I would say that. So let's actually do some tracing. Trace a sample of vouchers to the purchase journal. What are these vouchers things again anyway? Have we seen those before? Yeah, the voucher packets. So we actually aggregate the documentation associated with the purchase. That would be the purchase requisition, the purchase order, the receiving report, the vendor invoice, taking all these source documents and making sure that these are match what's in the system. So taking a source document, moving up to the system, that's tracing again. We're moving completeness, okay? So the test there. Again, I'm not asking for you to have memorized specific routines. You do not need to give me word for word verbatim responses in here. What I'm looking for is an understanding of the assertion and that everything aligns with that assertion. So can we say that all of these support the completeness assertion? I sure hope so. I sure hope so. Yeah, they do. They do. All right. For analytical procedures, again, with analytical procedures, a lot of this is going to be focused on those ratios and those trend analyses. I do want to point out there's something very interesting that gets added to analytical procedures. So what is one of the areas that in cost accounting that you had to look at? So remember back in cost accounting, Dr. Otero, I'm assuming you're talking to Dr. Otero, or even in management accounting, you may have taken that with somebody else. But one of those instructors that was talking about cost accounting, they'd say, well, we develop our expectation for what something's going to cost, and then we compare what the actual cost is to expectation. What is that expectation called? What is the term for an expectation? Give me a hint. Starts with a B and rhymes with budget. Oh yeah, budget. Yeah, that's what it is. It's a budget. Okay, yeah. So if we have an expectation and we as auditors have access to that expectation, can that be a source of information for us to actually determine how our organization is performing? Yes, if we look at budgeted results, so we say an organization is supposed to have $1 million in production of inventory for a certain period, and we look and they have $10,000 in production. Can we identify that as an area of concern? Yeah, comparisons to budget are very, very valuable in this area because we know that in inventory production in particular, inventory management in particular, that there's often concerns about what the budgeted amounts are. This is actually a point of contention. Back when I taught 221, I used to have conversations with my brother, who was he's currently a private chef, but he was formerly a general manager at Raising Cane's, and we would talk about what budgets are like. And let's just say when he was not on camera, he was very, very polite and very, very diplomatic when he was on camera, but he was not on camera. He had some very foul words to say about budgeting processes. Okay. Because he says the budgets are used more as a weapon rather than a productive tool. But that being said, if we use them as a productive tool, they can give us a lot of information because it's a guideline for how an organization should perform. So particularly with respect to inventory, we can actually look at budgeted information. We also can look at standard costs. Do you remember that from cost accounting? Okay, standard costs. We're going to talk about that here in just a little bit. Talk standard costs to use those as expectation developments for our for analytical procedures. All right. We did this before, we do it again. We're going to do this a few more times. I think this one's pretty okay. I did this for several of my slides, and I thought I was really clever, and then some of my slides are really, really bad like this, but I'm going to apologize in advance. I think these are okay. So I'm going to give you an audit procedure related to transactions, events, substantive testing, and you're going to tell me what assertion are we testing. So tracing a sample of receiving reports to the inventory records, which actually we just talked a little bit about. What's that assertion that we're testing right there? Completeness. Yes. Okay. Recompute the mathematical accuracy of a sample of inventory transactions, audit standard cost, or other methods used to price inventory. So sounds like a lot of mathy stuff. What does that sound like? Yeah, good. Examine a sample of inventory checks for proper classification into expense accounts. There's that word again. What do you guys think? Classification. Yeah, classification. Review a sample as time cards before and after period end to the appropriate weekly inventory report. Cut off, yeah. Before and after weekends, kind of the key there. And then vouch a sample of inventory additions to the receiving reports and purchase requisitions. That's EO. Now, quickly checking, is the vouching, is that used correctly in this particular example? So inventory additions to receiving reports and purchase requisitions. So we're talking about what's in the system, what's been added to the system, going down to the source document. So top to bottom. So that's vouching. Yep. Okay, we're good. All right. Let's do some more. This is our account balance tests. Okay, accounts balance procedures. Verify the inventory held on consignment for others is bill and hold goods are not included on inventory. So this is interesting. We've talked about consignment before. We talked about it last week. What did we say in that situation? We were talking about an organization that was holding goods on consignment for us. In this scenario, we're talking about us holding goods on consignment for somebody else. If we're the consignee, do we own the inventory? No, that's actually in the hands of whoever actually employed us to hold the inventory for them. So we don't have the responsibility for that inventory. That's not us. Doesn't belong to us. We can't put it on the books as an asset, and we don't have responsibility for the sale. So what does that sound like to you all, if that's the case? That's rights and obligations. Good. Observe physical account of inventory, account of physical inventory. This one's a really bad one. This is a much longer explanation that should go into here. The answer to this one is, technically speaking, multiple assertions, but I use this as existence occurrence, and I should update this, and I keep forgetting to do it every single semester. So I hope you guys will put that in my evaluation so I remember it, okay? Dr. Barnes forgot to update his inventory slides. There we go. All right, we've got it there. Obtain a copy of the inventory compilation and agree totals to the general ledger. This one's a little bit more straightforward. What do you guys think? It's more mathy stuff again. Yeah, we see a word agree. That's usually an indication of VAA, usually, not always. Trace test counts and tag control information to the inventory compilation. So we're looking at stuff that we actually counted on the floor. We're trying to make sure that the inventory records match what we counted on the floor. We've done that before. We did that before. That was actually part of our inventory testing, which we're going to talk about again. So what does that sound like to you guys? Completeness. Yes, completeness. Tracing, moving bottom to top. Good. All right. So we've talked at the very general level of talk about the processes, but let's get into some specifics about inventory. All right. So one of the first ones we're going to talk about, and these are the two slides that I made just for Dr. Otero, because she's one of my favorite people. And I think she thinks that I just don't take cost accounting very seriously, but that's just not true. I know for sure she doesn't take auditing very seriously, but this is my slides that I made just to make her happy. Okay. And to my knowledge, she's never seen them. So it's really kind of pointless. All right. So recall from managerial cost accounting, what are standard costs? Okay. And I know that you probably haven't memorized this definition. The good news is I got a definition for you. This is standard of the price cost, or standard is the price cost or quantity that's expected under normal conditions. The standard cost system is an accounting system that uses standards for product cost. And that's actually a direct quote from my slides when I taught 221. Okay, direct quote from my slides. Now, this is something that you should be somewhat familiar with, because standard costs are kind of the basis for variance analysis. Remember, you had to determine what the actual costs are versus the standard cost, and you compare those and you calculate those variances, and then you would go investigate the reason for the variances. The whole purpose is, to me, it's like, this is what we would expect. Like, you're making cheeseburgers. You'd expect that your standard cost is going to be $1 per pound of meat for a cheeseburger, which that's terrible. That's really low quality cheeseburger stuff right there. But $1 per pound, okay? And you'd expect to use a quarter pound in every single cheeseburger. And then you compare those to actuals and you see how do those differ from what your actual amounts are. And that would be the purpose of investigating. So standard costs are kind of a guideline for operations within the organization. Now, it's important to note, but it's not really relevant because we're talking about auditing here. So we need to know, how do we audit this? How do we audit standard cost? What is our responsibility here in this course? Because I know you already know standard cost because you've taken those multiple managerial and cost classes. So let's talk a little bit about auditing standard costs. Well, to do that, we need to identify the 3 types of product costs. What are our 3 product costs again? This is one of those ones. Yeah, I'm really, really excited when I get to say it because this is the one thing I know about cost accounting. It's materials, labor, and overhead. Remember, materials, labor, and overhead. So how do we audit standard costs for materials? We're going to test the quantity and type of materials involved in the product and the price of materials. So to audit standard costs, we want to know, all right, how much meat gets used in a burger, and can we see how this meat is distributed? What is the process for the actual creating the cheeseburger, understanding what is going to be utilized in this process. We talk about labor. Labor, we need to gather evidence about the type and amount of labor for production and labor rate. That's more understanding of the process and making sure we understand whenever the product is created, what is the expectation for time and effort that goes into this? And what are our expectations for the prices of the workers that are going into it? Which, yeah, that's pretty consistent with what we learned back in your managerial and cost accounting classes. But of course, we have overhead. Now, overhead's a really, really interesting one because the overhead is just depending on the method of allocation. We need to understand what is their method of overhead allocation. We determine that it's reasonable and compliant, where it has consistent, reasonable, consistent, and also has compliance with GAAP. All right, so we got that term there, compliance with GAAP. Does anybody have a problem with me saying compliance with GAAP? Or is everybody just kind of like saying, you know what, Dr. Barnes, that sounds right. Overhead allocation should comply with GAAP. Okay. This is one of the ones where if Dr. Otero was outside of the room, she'd come storing him and she'd start hitting me with something. Okay. Okay. Does cost accounting, is that follow generally accepted accounting principles? Not necessarily. Okay. So why did I put compliance with GAAP on this? So yeah, we're auditing and we're concerned about how it affects financial reporting. So it's not the overhead process that complies with GAAP, but the aggregation of costs that actually have to comply with GAAP. So we want to make sure that the reporting itself is compliant with GAAP and not necessarily overhead calculation. So even though overhead is not subject to GAAP rules, none of cost accounting is subject to GAAP rules. The aggregation of information as it goes to the financial statement does have to follow GAAP, and that's what we're ultimately concerned about as auditors. All right, moving on to my least favorite topic. Inventory counts. All right, what the book tells us is that inventory counts are a regular and important part of audit testing, and I don't disagree with that. I do think that they're very important. When we talk about an inventory account, keep in mind, we've already discussed this in this course, the inventory count is not conducted specifically by the auditor. It is conducted by the client. We are merely observing, and in some cases, reperforming some of those tests, okay? So when we talk about the inventory count, we need to know what our role is and what the responsibility of everybody else is. So before beginning inventory count, auditors should do a few things. First of all, if possible, ensure that no inventory production or movement will occur during the count. Now, in many situations, this will be possible, particularly if you're on one of those really, really mean audits where they say, all right, it is January 1st, 1201, start your count, okay? I've done a few of those. They're not pleasant, but they're an effective means of making sure inventory movement is not taking place at the time. Some scenarios, this is actually not practical. Has anybody ever seen an inventory account take place at a giant retail chain like Walmart? It is absolute chaos, and they do not get to actually have exact numbers. They're counting while people are shopping. People in these purple shirts that are just going and scanning everything as possible as they can and trying to get it all done, and people are trying to purchase, and if you can't stop people from shopping at Walmart while that's going on, it's just not practical to do. So if possible to do, if not, then we have to accept there's probably going to be some variation in the counts and the details. We also want to verify the count documentation is properly assigned. We talked a little bit about this earlier in the, or actually we'll talk a little bit about this week. Actually, I was confused. We're going to talk about what happens when count documentation is not properly assigned and safeguarded. So count documentation is going to note what the amounts are, both for the floor and the sheet counts, and make sure that there's not going to be any changes in those as the inventory count is occurring. So the auditor should maintain custody of those and safeguard those pretty heavily. Also, we want to ensure that the instructions are for the count are clearly understood by the count teams and the auditor. All right. Now, this one personally makes me a little bit angry. Okay. This is why I've got the little dog in the slide saying angry. This one, if done improperly, will not only lead to a bad performance of an inventory count, but also lead to a lot of hurt feelings. Because remember, I told you guys that when I was an auditor, one of my most miserable ones is doing it in the winter in Oklahoma. I had to actually climb to the top of a chemical storage tower, which is about 100 feet in the air. We're talking about like in 20-degree weather when the wind is blowing. And so that was my inventory count experience. That's the one I did every year for my during my associate years. So the first year I got very clear instructions from the senior on the engagement, and they told me exactly what I needed to do and what my responsibilities were and the counts were, and if there was a variance, what the responsibility were. My second year, I was not on the engagement, but I was the only person in Oklahoma that had access to it. So I went to the count and did it for them as a favor. They did not give me good instructions. They did not give me clear, detailed guidelines on what my responsibilities are. I did the count, I got the numbers, and then I tried to contact the senior and say, hey, here are the numbers. Do I need to do any follow-up work? Guess what the senior said? Absolutely nothing. Okay. Gave me no feedback whatsoever. I waited at the client site for 2 hours and I said, okay, well, I guess I don't have anything further to do. Then 3 weeks later, another senior, a different senior on the engagement, sent me an email saying, what did you do on this? And I said, okay, well, here's the numbers I came up with. So these don't match what the counts are supposed to be. I said, well, I tried to get the count information from you guys. You didn't send it to me. It's like, okay, well, let me give you a long list of things you did wrong. And so let me just say that that's not a conversation that I still am excited about. This was not something that I did wrong, and I'm willing to accept that. But the senior associate needed somebody to get really, really angry about, so they yelled at me for a little while. And yeah, that's why I say make sure that the instructions are very clear and they've been established. And they have to actually have that along lines. Otherwise, you get several years from then, and then like 20 years later, you get accounting professors who talk about their experience counting inventory and how it's miserable. It's not miserable for everybody. It was just miserable in that one instance for me. I had multiple inventory counts, but this one was one by far that I spent several hours climbing inventory towers. Has anybody ever seen a chemical storage tower? Yeah, the narrow stairway is like about this wide, which is, less wide than I am, and then I'm trying to climb up a spiral staircase on the top, and then the wind is blowing. Yeah, it just sucks. Okay, it just sucks. I had to do that and then get yelled at that I didn't do a good enough job at doing it. Okay, yeah, that's not what I want. I realize that now I've made everybody say, I don't want to be an auditor. If that's what Dr. Barnes went through, that's miserable. It's not every single audit experience. That was one audit experience I had. It was a bad one. It was a bad one. But it underlies the point that we've got to clearly communicate information. So let's go back to some things that we've talked about already. How are assertions tested at inventory count? Existence occurrence. Well, what did we talk about when we did this back in chapter 5? We said if we're testing existence occurrence, we want to make sure that anything that was recorded actually exists. So do we start with the sheet or the floor? The sheet, okay? The sheet represents the information in the system. And we go down, we check and see what's on the floor. Not literally walk down the stairs. I'm talking about drilling down from record to source, okay? Although if the system is upstairs and you walk down to the warehouse, that's just happy and convenient, okay? All right. So yeah, compare inventory quantities on record to the observed inventory quantities. That's going to be sheet to floor testing. Now, completeness does the exact opposite, doesn't it? We start with the floor documentation, the counts that are on there, and we check and see what's in the record. We start at the source. We move to the record. We're moving from bottom to top, which is tracing, okay? So we're actually going to do floor to sheet. Now, are those the only assertions that we're going to be concerned about? Answer is no. We've got some other assertions. We actually talked about another assertion that could be tested as part of this process. What was that one that we did back in chapter 5? I know I'm asking ancient history and a lot's happened since then, but let's see if you guys can remember. So remember we had a transposition error in one of our examples from chapter 5 homework. What did we say that was a violation of? VAA. And so VAA, we want to make sure that the inventory is going to be properly accounted for. We also want to make sure that we check the inventory that may be obsolete, slow moving, or carried in excess quantities. Why is this important? Okay, if we're talking about obsolete inventory, what are the rules for GAAP for obsolete inventory? If you cannot sell the inventory for the cost that you currently have, like the fair market value is less than what you currently have recorded at. I know that we can't upgrade, we can't increase our recorded at fair market value, but if there's an impairment in inventory, what should the organization do? Write it down or write it off. Okay, those are the GAAP rules for anything that's like that. So if it's obsolete, slow moving, that's something we'd be concerned about. This last one's carried in excess quantities. Why might we be concerned about that? Is there a potential for fraud if inventory is carried in excess quantities? It's not immediately obvious, but let's think about this. So is anybody familiar with the process of retail accounting? So some retail accounting processes involve measuring sales at an average gross margin, okay? So the way to think about this, imagine you have two products. Imagine you have two products, and this is just for simplification purposes. Imagine you have two products. One product has a 20% margin, and another project has a 10% margin. So on average, your products sell for 15%. Does everybody get the math there? 20 plus 10 divided by 2? All right. So let's say that I know this, and my products are selling average product. Which product am I going to want to sell more of? So yeah, well, technically speaking, I want to sell 10. I guess I should say, which one do I sell more of? I misstated my statement there. We want to sell 10, but which would I want to focus on having in inventory? If I were to purchase inventory, would I want stuff that sells at 20% margin or 10% margin? 20, okay, because that's what drives up my margin. So if like I have an exact equal amount of the two, that's a 15% margin. But let's say that I have 10 times as much of the 20% margin inventory as 10% margin inventory. Does that affect my margin? Because on average, it's going to drive it up. This actually occurred to me when I was working a long time ago for a company that begins the letter W, but you may know they actually are located here in Kirksville. The very brief time that I worked for that organization, I worked in the automotive department, and they actually used a retail method for all of their inventory. They would aggregate all their inventory in departments, and they would assign an average margin. And it turns out there was actually a store, one of the departments in a store that I was operating, that had bought these things, these large quantities of tire valve stems. Is everybody familiar with valve stems on a tire? That's where you actually put the air in to put them up. So one of these companies had bought somewhere along the area of $100,000 worth of valve stems, which I don't know if you know how much these things cost. The little small ones, like they're like 20 cents a piece. Okay. So $100,000 worth of those is massive, massive crates of those. The reason why is because they buy at something ridiculous like 5 cents a piece, and they sell for like $1, which is just a massive, massive margin. So the whole goal is that they have these in inventory. It inflates the entire margin for the organization or for the department. Suffice to say, when they found all these, the manager who was in that apartment got fired, and they went and they did an audit of the area. They said, "Why are all these boxes of valve stems here?" And they realized what was happening, so they had to ship them out to all the stores around the area. It says, "Do you need valve stems?" Says, "No, take them anyway." Okay, we've got way more than we use at this one store. It's actually a pretty clever way of manipulating a bonus, but yeah, it's also kind of fraudulent in nature. It's yeah. Anyway, all right. Rights and obligations, okay? We talked about this already with this talk about consignment of inventory. If organizations are holding goods on consignment for another organization, then they do not put that inventory on their books, okay? So basically, it's something that's beyond a bill and hold. We talked about bill and hold, and a bill and hold scheme is a fraud scheme. On a bill and hold basis for consignment, that's not a fraud scheme. That's just basically saying that you are the ones facilitating the transaction. You're the consignor that's going to send it to some other party. But if we're the if we're the one who's holding a consignment, we do not recognize that as an ownership interest. We do not recognize inventory. Conversely, let's say we have goods that we give to a consignor or consignee, consignee. So another company holds goods for us to ship to another customer. Do they own the goods? Do they own the inventory? No, we still own that because we're the ones who manufactured or purchased those goods. Even though they have possession of those, we still have responsibility for them. So rights and obligations, especially for consignment, is a really important objective to know. If we're the consignee, then we don't hold the responsibility for the goods. We don't have to hold them as assets. If we're consigning to another organization, they don't own the assets. And then cutoff, okay? Cutoff is not really a test of account balances, but still very relevant for inventory, okay? We want to make sure we obtain cutoff information, including the last shipping and receiving documents issued. This is going to be very relevant to making sure that we identify whether purchases or revenue transactions that occurred in the proper period. These more relate to those revenue and purchase transactions and examples that we talked about in homework last Friday. But the idea being is that inventory would be one of those areas that you could actually misstate the receipt or the shipment of inventory to actually facilitate those types of transactions, those types of misstatements, I should say. All right, some additional considerations. So what are some possible causes of book to physical difference? So these are where we say that we have a different amount in our books than we actually have on the floor. So inventory cutoff is going to be a first important one. That's going to be making sure that the transactions are within 2 to 3 days before and after period end are met. Also, there's unreported scrap or spoilage. Remember that from cost accounting. If there's errors in the manufacturing process, some of that has to be reported as scrap or spoilage so that you reduce the value of the inventory. And then, of course, pilferage or theft. That's probably the biggest cause of inventory book to physical differences. So Walmart says that they've got a whole bunch of inventory on hand, but because we are the checkers now, because we're the ones who check our merchandise out, some people say, oh, I've got this, but I really don't want to pay for it. I'm going to put it in my pocket, just like those bananas I was talking about earlier. You know, this is really big pockets. Okay. That's one big problem that organizations have, especially with the self-checkout systems, is that they've had a big increase in pilferage. Which, by the way, pilferage is just a fancy term for theft. I don't know why I used both of those together. I just wanted to sound clever when I said pilferage. Also, the inventory cost method used, that's actually going to affect how the valuation occurs. Keep in mind that this is going to be a factual misstatement if our client is not using a GAAP-approved method. We can determine what the actual amount of misstatement is relative to a GAAP-approved method. And it's important to note that we know what the method is and it's consistently used for both financial and tax purposes. Want to make sure that we're aware of any purchase contracts, any consignments, any pledged or assigned inventory. Okay, so purchase contracts and consignments are going to affect what the movement of inventory is now and in the future. And we want to make sure that we're aware of that so we can actually meet their noted obligations to the client. This is an interesting one. Have you guys heard the term LIFO liquidations before? I know you've heard the term LIFO before and you've heard the term liquidations before, but do these terms together mean anything? So let's think about the nature of LIFO. So LIFO is last in, first out, okay? Based on the history of all human universe, okay, what usually happens to cost over time? Do they go up or go down? Generally go up, okay? So we can assume that the natural trend of cost of products goes up over time. So if we're talking about LIFO, if we're talking about last in, first out, is that going to have higher costs on average than FIFO or lower costs? Higher, because we're selling the oldest stuff. Now, by the way, LIFO is an accounting trick. Do not use LIFO in your own refrigerator, okay? That's just a really bad idea, okay? It's like you may find some stuff that's a few years old and you probably want to get rid of. So last in, first out, just an accounting trick only. All right, so let's assume, for example, that I have a scenario where I'm a manufacturer, and I've got a bunch of stuff in inventory. I'm holding on LIFO. So it's really, really quote unquote old merchandise that's at much lower cost. Okay. So I'm holding this at a much lower cost because it's basically inventory that I'm counting for that was produced several years ago. It's not the actual physical inventory, but from a LIFO purposes, it is. And during 1 year, I have a boon in sales. I have an increase in sales that I didn't foresee. So I sold more than I produced. So I'm going to dip into that old inventory, which, remember, that old inventory is going to be lower cost because it's being held at those LIFO amounts that are much lower because of the increasing cost over time. What is that going to do to income for that period relative to income from other periods? Not the actual income, but the percentages of income. Will income or gross profit, that's an easy way to identify it. Would gross profit percentages be higher or lower? Higher. Yeah, cost of goods sold would go lower because we're selling lower cost inventory. And so gross profit percentages would be higher. Now, what would happen if our client, we're talking about where, as an auditor, our client sends the financial statements out to their stakeholders. What are the stakeholders going to react? How are they going to think? They're going to say, happy day, we're seeing improvements. This is going to go on forever. We're going to make billions and billions of dollars because we've got improvement. Is this a sustainable position? No, okay, because eventually you're going to run out of that low-cost LIFO inventory. Now, you didn't run out of current period. So a LIFO liquidation is basically a cause for concern because stakeholders may react improperly to the increase in profits. In that situation, we as auditors may step in and say, all right, client, you need to make a disclosure saying that you sold more than you produced during this period, resulting in a LIFO liquidation, which meant that costs were lower and the stakeholder should be aware that this is not something that's going to be recurring for future periods. This is actually something that happened to a lesser degree. This happened with Southwest Airlines during the 2000 aughts. So we're kind of used to the fact that gas is right around the upper $2 to lower $3 range right now. But there was a massive increase right around 2006, 2007 in gas prices. It was in the $1 to $1.50 range, and it jumped up to nearly $4 per gallon within about a year worth of time. Southwest had hedged gas purchases for several years at lower rates. And so they were experiencing massive, massive income spikes where other airlines did not. They were losing money. And Southwest had to disclose saying, this is only because we hedged these prices. We hedged these prices in gasoline for a period of time. Once those hedges run out, we're not going to be able to purchase gasoline at those lower prices anymore. And so that was kind of an interesting parallel there. Also, purchase or sales to related parties. We've already talked about this already. Related party transactions must be disclosed by the client. The nature of the transactions and who the parties are. That is a GAAP requirement. We as auditors not only have to make sure that we understand the nature of related party transactions, but that we ensure that our client makes proper disclosures for related party transactions. And then also warranty obligations. So has anyone ever bought anything on warranty? Okay. What is the accounting treatment for warranties? Is there warranty concerns that can go into the cost of inventory? Yes. So warranty costs can actually be impounded as cost of inventory. Usually they're expensed when incurred, but you can actually have a warranty allowance similar to like what you would have for accounts or allowance for accounts receivable that can be accounted for those warranty costs. So we want to know what the treatment is for warranties on certain types of high-level inventory that actually has warranties associated with it, and how the organization accounts for that. It's kind of the same thing with any subjective calculation. We want to evaluate the reasonableness of those estimates. There's a lot to go over with respect to inventory, but the good news is we're done. All right. So you guys have chapter 12 and 13 homework on Friday, and I will see you all then.